no surprise that those were spaces that outperformed the broader market. But if I'm thinking about where that next opportunity is, I'm looking over here at the right-hand side of this chart. I'm looking at sectors and industries that not only have underperformed the market, but have traded at a lower level than they were coming into 2020. There's a number of spaces that are trading at double-digit discounts to where they were. And certainly there's some bigger issues when you think of something like energy, airlines, getting people back to those. That's a longer-term trade, but I wanted to bring this chart up because I think there's a generalization that when the market's at an all-time high, everything is expensive. And this chart is showing us that that is not true, that there's a number of sectors and industries that are cheaper than the general market index, but even more that are cheaper than where they were 14 months ago prior to the pandemic. And we think that those are positions that are poised to benefit as we continue to see things reopen. Also, if I'm a long-term investor, this is a mountain chart I want to participate in for profits. You know, we had a number of distractions last year that would have made us feel like, you know, the market was moving based on things other than profitability. When I look back over the last 30 years, at the end of the day, the market is driven by the companies that we own, their ability to make money, their corporate profits. And this chart shows through multiple recessions, the resiliency of the corporate sector. And so by mid-2021, you can see those blue lines on the far right-hand side, the blue bars, we're expecting corporate profits to hit an all-time high by summer of 2021. And that we think is going to continue to bode well to own US equities here in the United States. We know that there will be recessions in the future, there will be volatility in the future, but companies continue to be very resilient with how they generate profits on a quarterly basis. And you know, from where we were this time last year, there's less unknown about the vaccine, about the virus, about what we were going to see down in DC. So this is helping the market digest that and continue to push higher. So takeaway on this chart would be, despite all-time highs in the market, corporations continue to set records in terms of earnings, which is why, at the end of the day, I would want to be invested in them as they continue to trend up.
Hey, Todd, let's take just a quick second. We've
Yep.
had several people hop in that I've noticed since we started. So just real quick, housekeeping for you guys that just jumped in. There is a chat feature on the screen that allows you to send us a question. When you click that chat and want to type your message, what I'm going to ask you to do is send it privately to me, because you can send it to the whole group of everybody that's on here. You can send it to Todd, but I want you to send it to me privately. So that way I can kind of filter through these, and I'm trying to read the questions as they pop up. I'm going to hold the questions until the end and ask Todd at the end all these questions. I just ask that while you're thinking of your questions to send it to me now, so I don't get a whole bunch sent to me all at the same time at the very end, because I want to make sure we try to get as many questions answered. So click that chat feature and then send it to me privately. You'll be a drop-down box and just click send it to Mark Roberts. All right, sorry Todd to interrupt, but I thought I'd jump in there before we top.
That is fine. That is fine. It's a good transition because we've talked about the economy and the great reopening. We've talked about the market continuing to trend towards all-time highs as people gain confidence, get out and about. So what are some things that we're looking at as far as risks? And one of the risks that we see is unemployment, and seeing this number continue to trend down. Currently our unemployment rate here in the United States is a little over 6%. It's about 6.2%. Now, when you look at the 50-year average, that doesn't seem that far out of sorts. Long-term average is 6.3 on unemployment. But we're concerned about this because we were in such a healthy spot, not just 12 months ago prior to the pandemic, that this is going to continue to be a pain point as far as the health of our economy, and when we're going to see the Fed feel comfortable enough to raise interest rates. But I wanted to emphasize this chart just to show how, as people came off of furloughs, as things opened back up, we went back to work, and we're going to continue to see that. But what's also started to occur is wage growth. And this is not, a political bullet point on minimum wage. It's just, frankly, people are being paid more to, or at least when they change jobs, there's more incentive for them to work, because the skilled labor that we have out there is few and far between. What we find is that there's been a lot of jobs that have come back in a number of sectors here. When I look at the left-hand side, from February of 2010 to February of 2020, that's a decade. We created 22.8 million jobs here in the United States. Over a 90-day period, we lost 22.4 million of those jobs. So a decade of job growth erased in 90 days. There's going to be a lot of shocking COVID type stats that we hear over time. To me, that tells me why our economy was rocked so hard, because if we are going to be consuming and driving growth, we're most likely going to have some sort of employment or some sort of income coming in, right? And we didn't see that for a number of folks. Now, since things have opened up, we've brought back almost 13 million jobs. Those are people coming off of furloughs. But that still means that we're about 10 million short. We've got 10 million people that were working this time last year that are not working. And they're tied specifically to one space. You look at the right-hand side here, we lay out all these different spaces, but leisure and hospitality stands out. We've only brought back about half of the jobs that we had prior to the pandemic. And why that's important is because that's going to be driven based on demand. We have plenty of hotel rooms available. We have plenty of seats on airplanes available if people are willing to go out and use those. And so as we see this pent-up demand start to take place, where they start going on vacations, going on weekend trips, there's going to be this pent-up supply of people who are looking for work in these industries is going to drop too. So the unemployment rate, as we sit here today, we think is tied directly to our ability to get out again. You can see a kind of a common theme here. It all does roll back into getting back to whatever this normal looks like. But leisure and hospitality is a huge reason why we still see that unemployment rate up where it is. And why that's important, why I spent so much time on unemployment, is because it ties directly in to the rate conversation and to inflation, which I'll spend a minute on.
Hey, Todd, before we jump into interest rates, do you mind? I'd like to go back and ask you a question 2 slides previous on, okay, one more right there. Looking at that dark gray line, I saw unemployment, of course, April of last year go to 14.8. I can't quite see it on the slide here. At the low point, right before the pandemic, would you say that was maybe unemployment like around 2.5? No, let's see, more like 3%?
About 3.7%, which was the lowest it had been since the late 60s.
So 3.7%. And the difference between the 3.7% versus where we're at now at 6.2% is roughly about 10 million jobs. Is that what that boils down to?
Yeah, about 10 million people that are out remember, these are people who are actively looking for work. That's how they factor into unemployment. We have had people who are unemployed who are not looking for work, whether they retired or they're just disenchanted because they don't think their job exists anymore. But yeah, I think that's the best way to look at it, Mark, is we've got about 10 million people that are actively out looking for work that were employed this time last year.
Okay. Well, it's one thing to lose a job, but to lose a company that went under because of COVID, and one company can supply lots of jobs. That's why I think it's going to be a slow opportunity to grow back. There's only so many jobs we can already create, but as businesses start back up, that's where we can actually start hiring more people at the same time, and hopefully that'll be what we see as things move forward. New businesses starting back up, and then hiring as well.
Yeah, which is, it's a good dovetail into, why we think rates are going to be low for longer. We look at, what the Fed has been very transparent on is they're looking at 3 indicators as far as raising interest rates. So just to explain this chart, your gray line here, that's your Fed funds rate. Now that's what I earn on my cash down at the bank, or what I would earn on a CD in terms of rates. And back in March, the Fed cut rates to 0. As a way to incentivize folks to invest in the market. Now, that's not the first time they have done that. They did that in 2008, and you can see how long we were in this 0 rate environment. We've only been in this for about a year, but you can see whether it's the market or FOMC, that's the Federal Open Market Committee, that's the individuals that control the Fed funds rate. No one is expecting rates to go anywhere anytime soon. But why is that the case? They're looking for 3 things. They're looking for GDP growth, unemployment, and inflation. And so by 2021, by the end of this year, they're hoping that GDP is over 4%, that unemployment is at 5%, and that inflation is about 2%. Now, I'll tell you, by this summer, I think we're going to have GDP numbers above 4%. I think we're going to have inflation above 2% as people get out and about and start spending. These stimulus packages that have been provided, we've had more people sit on that cash, whether it's uncertainty or not being able to spend, than we've ever seen. personal savings rate last year was 15%. That's an all-time high. And that's not because I think we've all become good savers over the last 12 months. I think it's because we haven't had the ability to consume. So I think inflation is going to be at 2%. What I don't think is going to be at that point is unemployment. And Mark touched on this. I think that this next phase of the unemployment rate going down is going to be slower, as it's not necessarily us bringing people back to the workforce that have jobs waiting on them. It's people who actually have to go out and look for a job. And so that's going to be the, I'd say, the laggard and a justification for why the Fed's not going to raise the short-term interest rate, the Fed funds rate. Now, what could change that? If we saw inflation really take off, I mean, I'm talking 3 or 4% inflation, then that would give them incentive to want to raise interest rates. Now, we're just trying to get to 2% at this point. So we're a ways away from that. But if we see inflation taking off like that, then that could be a catalyst for the Fed to raise quicker than 2023. And Mark, I don't know if you have any comments on, on what you've seen on within inflation or what you're doing with portfolios, but that's certainly been a hot topic over the last couple of weeks.
Yeah, let me make 3 quick remarks. Number one, I don't know if you just saw that, Todd, but we just had join our group. We had Patrick Mahomes just join our group.
Yeah, no, I that's why I stuttered.
So no pressure there. Number two, what I'm looking at is back in 2008, when the Fed dropped the interest rates, what they did, it looks like 1, 2, 3, 4, 5. So they went from where it was down to 0, but it took them 5 steps to get it down, dropping it down, dropping it down, dropping it down. Whereas what we experienced last year, they took the interest rates all the way to 0 in one fell swoop. So that's kind of unheard of for them to take all the way down to 0 in one fell swoop. So it's not that we've not been to 0 before. It's not that we went, what I would say is last year, this is the first time we've ever went to 0 in one fell swoop.
Yeah.
So that was something else I noticed. And something on inflation. Todd, I got this, I do a lot of reading on this stuff, as you know. I want to see what your opinion is, or JP Morgan's opinion on this as well. As we start getting vaccinated and we go back out to society, we're doing more, we're going to drive back to work instead of like you're working from home. We're going to have a lot less of that, but that's probably going to be the new norm. People are going to be doing a lot more remote working, but we're going to get more people out. Point is, I think there's going to be a definite increase in demand of oil, therefore gas. And isn't gas and oil, when you say, isn't that a really good indicator of inflation? As that will start to go up, we'll start to maybe see inflation as well start to creep up just because of that demand. Is that a good way to say that?
Yeah, because oil's been working in the opposite direction over the last few years, as we've seen a price of a barrel drop and price at the pump drop, because some of us may be on the call thinking, well, it's inflation seems like it's not a huge deal right now, but I go down to the store and I know it's more expensive for me to buy meat and buy eggs and buy some of these other, commodities that have seen higher inflation numbers. So oil and natural gas have certainly offset that as we saw those prices decline. As they go up, so will the inflation rate. And so, I think, I wanted to spend so much time on that because the primary reason that we invest is to make sure that the dollar that we have in our pocket is growing, not shrinking. And inflation can be one of those silent killers of the dollar that I have in my back pocket, whether it's 2% or 4%. It's the eroding value. And so this is never, it had, at least since the 70s, it hasn't been a front page headline concern. But with all the money that we've printed and with people with this pent up demand to get out, there's certainly a concern that it can take off.
Well said. Thank you for that.
Yep. One quick slide on international, because I know a lot of us on this call, we have diversified portfolios. We've got equities, we've got fixed income, we probably have some money outside the US. This chart here is pretty telling in terms of performance of the US stock market versus international. And this is looking back over the last 25 plus years. So your gray line is the US stock market, and it shows the peaks and valleys of performance. And you can see that drawdown that we had during COVID. The purple line is what is, the acronym is ACWI-X US. That stands for the All Country World Index minus the United States. It's essentially everybody except us. And you can see pretty much since the last recession, we'll go to 2011, the rest of the world has had a very difficult time keeping up with us. Now, a lot of reasons. They had two recessions. We had one in the 2010s. They've got an older population that typically has less exposure to equities. They've had to deal with Brexit. There's a lot of issues that have played into this cheaper or less, underperforming space of international. Even through this recovery, we've seen the U.S. outperform international. So I bring this up because more than likely you have a position in the portfolio in the international space. Why? Because it's cheap, because we know there's good quality companies there that will outperform over time. What I would say here is that over the last 8 years, that has not been the case. The U.S. has been the dominant force. What could change that? What could see that pendulum swing back? A weaker U.S. dollar. The dollar has held a place of privilege against all other currencies in the world. We could see the dollar weaken if certain economies across the world recover from COVID faster than we do. But we also would expect an easier trade policy out of DC as opposed to what we've had over the last 4 years. So an easier trade policy, whether that be with China or other countries we do business with, that could lead to a weaker dollar as well. Weaker dollar tends to benefit international investments. Same reason why over the last 8 years, a strong dollar has hurt your international investments. So this gets back to that old adage of not putting all the eggs in one proverbial basket. We know that although international hasn't lived up to expectations over the last few years, there's a reason we own it. And the reason I would say is it continues to be cheap, and it does have some tailwinds with a weaker dollar and easier trade policy.
So Todd, not to date myself and make me feel too terribly old here with our group, but I got my 25-year anniversary doing this coming up here in June. Do me a favor, go back a slide.
Sure.
Right there. I remember back in the day, I think we all kind of remember where we were in 2007 when the market started crashing, October of 07, all of 08, and then up until March 9th of 09. And I remember distinctly back in those days, before all that hit, we were super close to running a portfolio in our models of about 50-50 US to international stock ratio. And after that market correction and how we handled the market correction, we got back in the market, we got diversified. I remember distinctly back in those days how we chose at that time, again, the US versus everybody else. We went very dominant in our portfolio with US stocks for the stock side of our portfolio, still kept international, but way less, where before it was kind of almost a 50-50. Now it's just drastically different. It's almost more like an 85-15. 85% of the stock that we have would be US and 15% of the stock might be, international. And so I'm looking at this chart, like that just really made me feel like, wow, I remember those days back then when international was doing as good as the US. And it hasn't been that way ever since.
Yeah. And that's the benefit of, having the ability to make that call too. It's something that few advisors have, have the foresight to make that call or have the ability to within their system. So certainly it tells you that, there's points and times where that happens, but it has been quite a while since we had a conversation around international being a consistent outperformer. Okay, I'm going to finish just with one chart here and then we can open up for questions. I like to finish with this chart because all of us on the call, one of the primary reasons that, we get a little uneasy about the market is volatility. And, what I will say is one sentence takeaway on this would be that a vaccine is not going to immunize us from future market volatility. A vaccine is not going to immunize us from future market volatility. It's certainly going to help us in terms of what we see in total return this year and just feeling better and being able to get out and move around. But there's going to be other reasons why the market draws down. And this chart here is a friendly reminder that volatility is normal. We can't let it derail. So each year we've seen over the last 41 years, there's a red dot. That red dot represents a drawdown that we see in the stock market. And it's been anywhere from a 3% drawdown to a 50% drawdown. Last year, we had a 34% drawdown. And I just thought it would be a good chart to finish on to emphasize that more oftentimes than not, the market finishes in positive territory. And, we're most likely going to see some sort of drawdown this year. The difference between what we saw in 2020 versus this year is that, that 2020 was a black swan event, something that happens once in a generation where we don't know how long it's going to take for us to recover. There's a lot of unknowns there. I think the next drawdown most likely is going to be driven by, a company missing earnings, a sector underperforming, perhaps something more tied to the politics in DC. But as far as it being something like a health crisis where everyone has to fundamentally change how they live and operate on a daily basis. That's something that we don't see happen very often. So I think this year we're going to have less volatility. I think it will finish in positive territory, but I just think it's a nice reminder that, last year, certainly a volatile year, but volatile years are relatively common. They happen, if you look back, depending on the velocity of it, it happens every year. So with that, I'm going to pause, and Mark, I'll turn it back over to you to see if we have any questions that we can address.
Yep. So everybody remember, if you want to send us a question, do it on your chat feature. Just make sure you mark it private to Mark. That way it comes directly to me, and I'll make sure I read these and get these questions asked. I got a handful of questions here. Let me start with one that was specifically to mortgage applications. Let me go back to that particular slide. There we go. Question is do you expect mortgage applications to continue to be a downward trend? With interest rates being so low, interest rates most likely going to have to creep up. Mortgage rates, I'm thinking it would have to be decreasing. Wouldn't you agree?
As far as people wanting an application or the actual rate on an application?
It's not being specific in that question. I'm kind of taking the question as I think it's strictly asking about applications.
Okay. Yeah, I think that as long as, what I'll say is one of the biggest ticket items that you can buy is a house. And we wouldn't be willing to go out and buy a house if we didn't have the confidence in our current financial standing. So the fact that mortgage applications are relatively flat year over year tells us that there's a big subset of the economy that was confident enough to make that call. I think that applications, you could certainly see them go down as interest rates go up, right? Because we've continued to read articles in 2020 that rates were at record lows. Well, that's not going to be the case moving forward. We're going to start to see those interest rates creep up. And you may have like a short-term boost of people feeling like they're missing out and they need to make that call today that might have been sitting back and waiting. But I think the trend here is that you're going to continue to see that go down as people realize that they're going to be paying more on a fixed and certainly a variable rate mortgage if they apply 6 months from now as opposed to today. So I think that that's a trend that will continue. We may see a short-term boost here if there's enough articles out there saying, you have to get in or you're going to miss it, because certainly that could provide. But I do think the trend is down.
All right, another question has popped up. This is a good question. I think it's commonly asked here in our office of clients. What's JP Morgan's outlook on the tech sector? Do you think it's going to recover, or do you think it's going to continue to get some pressure?
Yeah, I think tech has had the wind at its back for, at least 5 years now, and it drove a lot of the return in the market and in client portfolios last year. So, and that was just a handful of companies you could rattle off, these mega cap companies, if you will. I think what we're seeing over the first 8 weeks of the year is what this chart shows is, people are buying into these discounted spaces. They understand that those mega caps drove a lot of the return, but they've got some headwinds coming up. Number one, regulation. I think that there's certainly some fear around future regulation of these companies that have driven a lot of the market over the last 5 years. So anytime you have a fear of regulation, you're going to see some volatility in those individual stock prices. I don't think technology is going away. I still think it's going to be a dominant space in the S&P, as we've learned over the last 12 months how to somewhat live in an online world. There's online conveniences that we're not going to turn our backs on, like a DoorDash, like having groceries delivered to our house. These are things that, maybe we thought we would do 5 years from now that we're doing today. I don't think that's going away, but I do think diversifying away from the tech sector, the concentration risk of the tech sector, given how much it's grown over the last 5 years, is concerning to us at JP Morgan. I know our top growth managers have their largest underweight coming into this year was those mega cap companies, because they felt like they had put enough hay in the barn when things were good. They wanted to put that money to work in some cheaper spaces.
Okay, that's good. Good answer. Next question that we have up here is, what's JP Morgan's view of maybe the top 2 sectors that might do really well this year?
Yeah, so I think that those, will stay on this chart. I think they really tie to what's going to benefit the most from us reopening, and a higher 10-year treasury environment. As we see things like mortgage applications, interest rates on those go up. the two sectors that jump out to me are financials, specifically banks. And then also I like the consumer staples space. These are all areas that I think we're going to see increased spending in, but also increased bottom line profitability from the financial space as we come off of rock bottom interest rates. I want to make sure I clarify there that what I said about the Fed funds rate, that's controlled by the Fed. That's not going to move in our opinion, but variable interest rates move. And we're seeing those move up for the first 2 months of the year. And anytime you see those move up, the bank's bottom lines are going to benefit. I think banks pay a nice dividend yield as well, which is just, in my mind, somewhat free money. If we're holding that bank, we get a nice 2 to 3% income check in addition to seeing that the stock price grow. So consumer staples and banks are two areas that I think are still significantly cheaper than the market, and haven't seen that second phase bounce back as we're reopening. I definitely think will benefit through the year.
Okay. Here's a question on gas. Give me a second. I'm going to read all this here. It says, if gas prices continue to rise as we become more dependent on foreign oil again, can we expect inflation to rise accordingly due to the impacts of all goods and services? I think that was kind of a question that we kind of talked about earlier. As we get back out and we start working more, we get back out and socializing again, we're going to be using oil and gas. And that's going to drive more goods and services, what you say.
Yeah. And you can see here, I mean, this can be a bit busy chart, but I want to make sure that, we know we are still producing here in the US. Over the last 3 years, we've grown our energy production by about 10%, whereas OPEC has dropped theirs by about 9%. Russia, we'll say little up, but global production of oil over the last 3 years is flat. Now, consumption over that same time frame is up. And this gets us back to just basic supply and demand 101. Anytime the supply of something goes down, but the demand goes up, that's going to push the price up. And that's what we're starting to see here on the right-hand side. A barrel of oil got as low as $11 in April of last year. Today it's at 65. That is because we haven't seen the production across the world, not just in the US. But if you really had to highlight someone that's been increasing production, it's been the United States at an average of 10% a year. We think as the price of oil goes up, so the rig count will. You can see rig count starting to tail up and to the right here. Inventories are going down. This crossed 5 years ago. So all this is telling us that demand is coming back as countries get back online, as people get out again. I think that plays into higher energy prices. And, for those large cap energy companies, their break even point on a barrel of oil is about 50, 55 a barrel. So they're actually back to a point where they could be profitable at oil at this price. So, long answer to that question. But I do think that, this lack of production globally is actually going to be what pushes those prices higher, not just the United States is, dependent on foreign oil. I still think we have a pretty strong foothold here in the production that we've created over the last 3 years.
Okay. Next question. This was a good question here that was actually brought up by Angela here in our office that asked me to run this one past you. Market's up a little bit for the year. It's not up stellar, but it's up a little bit for the year. Thoughts that JP Morgan would have on the $1.9 trillion stimulus bill, if that is already fully priced into the market?
Yeah.
Like the benefits that we're going to see from it's already in the market, or do we expect the market to maybe want to continue to go up off of this stimulus?
Yeah, I think that the 1.9 trillion, as it's been written, as it will be written into law today, or this week, I should say, has been baked in. I mean, there's not a lot of surprises there that would have changed the market's telling us that. They're passed, the minimum wage was reduced, but the unemployment benefits were extended. That didn't create volatility in the market. So I think that 1.9 has been baked in. What hasn't been baked in is whether people take that stimulus check and spend it, because this is going to be the largest check that they're receiving, and it's going to be at a time where they have a little more ability to move about. So, last year I referenced we had savings rates at all-time highs, and I said that's not because we all of a sudden had a change of heart and became great savers. It's because we couldn't it was more difficult to spend money than it's been in decades. So yeah, I think that we haven't factored in or baked into the market how that spending can impact certain sectors of the economy and certain sectors of the market. And if we do see people get out there and spend, that should lead to higher numbers on the stock market.
So to clarify something that I heard you say earlier, I want to make sure I heard that number correct. I think you said something like the people who are going to benefit from this stimulus check that's coming in the mail is going to be 9 out of 10 Americans. And I'm assuming you meant 9 out of 10 working, paying tax Americans.
Yeah. Yeah.
Is that right?
Yeah. Yeah. Roughly 90% of working tax-paying Americans are going to receive a stimulus.
Now, is this $1,400 check really going to drastically change people's lives? Because that $1,400 check, even, not for my typical client, our clients that, either don't qualify or it's not very much for them, but the average American, even the average American getting $14, is it really going to make them go out and spend so much more money just because of that $1,400?
No, it's not going to change their life, but it's certainly going to give them some disposable income to buy things, to consume. And so, if you've got $1,400, you may be more apt to buy a new TV as opposed to not buying a new TV. And so that's what we're looking at. It's not going to change anyone's life, sending them a $1,400 check. As much as we'd like them to take that money and invest it and see it grow in the market, more than likely it's going to get spent on something, whether it's something that they need or they want. And I do think that, with this being the third round of a stimulus check, that the $1,400 may go to something that they want, which is going to benefit some of those sectors that people pulled back on last year because they were watching their budgets. So yeah, not life-changing, but certainly is going to increase consumption based on the fact that people are going to be spending this and have more ability to freely move about and spend it.
So somebody just popped into questions. It's kind of funny. I'm starting to giggle at it. It's like, all that check is going is going to go help me pay my taxes.
Yeah, I know. Believe me, we're having this conversation. There's a lot of folks on this call that are not going to get a check. And they're saying, well, how's this going to benefit the general economy? And it really does come back to that first chart we talked on, which is, our ability to consume is unparalleled to other countries. We are a service-based economy, a consumption-based economy. That big blue box hasn't been pulling much weight with the GDP number over the last 12 months. We see that changing.
Good. Well, okay. So anybody got any more questions? I'm going to ask Todd one more question here. And so you have just another minute or so if you want to fire me off one more question. Todd, this actually comes from Pat in my office here. Pat's a celebrity here in our office. Probably more people know Pat than they probably even know me with our clients. Pat does a lot of reviews. He takes care of a lot of service requests. So Pat's making a comment that value stocks are picking up steam again, and want to see if you can give your version, JP Morgan's version of explaining to our clients that are on here today, what's the difference between a growth stock versus a value stock, and why value would help diversify a portfolio in addition to growth-based stocks. So could you give us like your version of that?
Yeah, so growth stock, large cap growth stock would be, like a Google. These are companies that have grown incredibly fast over the last 20 years or so, but the profitability that they're making, they're choosing to reinvest in the company as opposed to buying back shares from the market or paying a dividend to its shareholders. So something that would be defined as growth would be a company that's growing at a faster pace than some of these companies that have been around for decades, but also a lot of the profitability that they're generating, they're putting back into the business to continue to grow. A value stock would be a company, like a Johnson & Johnson, something that's been around for 100 years that grows, but certainly not at the pace of a Microsoft or a Google. And they choose with their profits to reward shareholders through dividends or to buy back shares if they feel like the shares in their market, in the stock market, are trading at a discount relative to what they value them at. So value companies, I would refer to as these blue chip household names. You look around your house and you see, okay, who made this, or what am I using in terms of cleaning the house? All those would be value companies, household names. Growth companies, certainly there's companies we could roll off our tongue that are household names, but the biggest differentiator between the two is the dividend that's paid by value companies and the buyback, their ability to buy back shares. Value had a very tough 2020. If I just take a minute here, Mark, to kind of show clients the difference between growth and value last year, it's pretty telling. I mean, growth, since over the last year, growth was up 20%, value was up 10%. I'm looking at the bottom left-hand group of boxes here. Now, year to date, you can see large cap value is doing much better than growth. And I think that gets back to this participation in the rotation. We're seeing a rotation in the market from growth to value. We want to make sure that we're participating in that by owning value companies. Hopefully that's helpful in not only differing what is growth and what's value, but why we're seeing this rotation take place. Companies that have been around for decades are benefiting more than growth companies as things reopen.
That was awesome. That was really, really good. All right, so I don't see any having more questions here unless they've sent them in a way that maybe I'm not catching it, but I'm looking at all my, hold on here. All right, someone's messing with me. We got a message here from Patrick Mahomes said, I just had a baby and need some life insurance and asked us if we sell life insurance. All right, someone's messing with me.
I'll let you handle that one, Mark.
Well, I'm going to talk to Patrick here in a private message, I'm sure afterwards. Todd, this was outstanding. We went for 55 minutes, just under our hour, which is awesome. Want to thank you so much for all that you do for my team, my analysts, just always being there for us every time we have questions. You've always been a real rock for us, and JP Morgan has been outstanding throughout all these good years, but even last year's craziness, you guys have just constantly put out good data that we can use to help us help clients, and then help us explain things to clients in ways that make sense. So Todd, thank you so much. Appreciate you being on here.
Yeah, and I'll say one thing for working with you guys over the last 8 years. I cover a lot of advisors in Kansas and Western Missouri. There's very few that have the ability to do what Affinity Team does. Number one, events like this. Client education is, I think, one of the most important things. We fear what we don't understand, and the fact that you guys are getting back to doing these on a quarterly basis, making it available to those clients and future clients, it separates you. So, I would say thanks for having me on, and keep up the good work with doing these, because even in a virtual world, they go a long ways.
All right, on. Well said. Thank you so much for that. Everybody else, I wish you health and safety. I personally have been through COVID in the early part of February. It's nothing to, can't take that lightly. I mean, this stuff is serious, and I've gotten it from others. I've passed it to others, and it affects all of us very differently. My wife had so minimal symptoms, but then I had quite a bit of symptoms. But then a couple of people that I also know that got it have been in the hospital for a couple of weeks from it. And everybody's very, very different. This virus is just nothing to take light. So continue to be smart, continue to be healthy, continue to wear your masks, go get shots if you believe that when that comes out available. So get that done. So thank you everybody for taking time out of your day to listen to us talk here today. If anybody wants a copy of the PowerPoints, definitely just let us know, call us or shoot us an email. I'll make sure we'll shoot that over to you right away. On that, thank you everybody so much for coming. You guys all have a great rest of your day.
Thank you.
Thanks again, Todd.